Choosing the right business structure is a critical decision for entrepreneurs and small business owners. Among the most popular options are limited liability companies, LLCs, and S corporations, S Corp. While both offer liability protection and pass-through taxation, they differ significantly in their financial and operational implications. An LLC is often favored for its simplicity and flexibility, while an S corporation provides additional financial advantages, especially in terms of tax savings and income treatment. Understanding these differences is key to maximizing profits, reducing tax burdens, and achieving long-term business success. In this video, we'll explore the top 10 financial advantages of S corporations versus LLCs, shedding light on how choosing an S corp might save your business money. 1. Salary and dividend splits reduce self-employment taxes. One of the biggest financial advantages of an S corporation is the ability to split income into salary and dividends. Unlike LLC owners who typically pay self-employment tax, 15.3%, on all net income, S corp owners can classify part of their earnings as a reasonable salary, subject to payroll taxes, and the remainder as distributions, not subject to self-employment taxes. This can result in substantial savings on Medicare and Social Security taxes. For example, if a business owner earns $120,000 and pays themselves a $60,000 salary, only that portion is subject to employment taxes, potentially saving thousands annually. 2. Avoiding double taxation. S corporations, like LLCs, benefit from pass-through taxation, meaning that income is only taxed at the owner's personal level rather than being taxed twice, once at the corporate level and again at the individual level. This is a significant advantage over traditional C corporations, which are subject to double taxation. While LLCs also avoid this, the S corp takes it further by optimizing the tax structure through strategic compensation planning. For business owners looking to drop profits without triggering extra tax burdens, the S corp structure often provides a more tax-efficient route. 3. Greater retirement planning opportunities. S corporations provide more flexibility and potential benefits when it comes to retirement plans, particularly solo 401(k)s or SEP IRAs. Since S corp owners who are employees can pay themselves a salary, they can make employer and employee contributions to these plans, increasing the total annual retirement savings potential. In contrast, LLC owners must rely solely on net earnings to make contributions, which can limit the amount they can contribute and deduct. Over time, this makes the S corporation an attractive choice for entrepreneurs focused on long-term wealth accumulation and tax-deferred investing. 4. Potential to deduct health insurance premiums. S corporation owners who own more than 2% of the company can deduct health insurance premiums for themselves and their families, but it must be handled properly through payroll and reported as income. While LLC members can also deduct health insurance under certain circumstances, the S corp method is often clearer and more structured for tax filing. These premiums can be included as a business expense and taken, above the line, on the owner's Form 1040, reducing adjusted gross income, AGI, and possibly qualifying the owner for other income-based tax deductions or credits. 5. Enhanced credibility with investors and banks. From a financial standpoint, S corporations tend to carry greater legitimacy in the eyes of banks, lenders, and investors compared to LLCs. The structured nature of an S corp, with required shareholder meetings, board resolutions, and stock issuance, offers a level of formality that many financiers prefer. This formality can make it easier for an S corp to obtain business credit, loans, or even venture capital, especially when compared to a sole member LLC. Over time, the improved access to capital can translate into significant financial leverage and faster business growth. 6. Easier equity compensation through stock. Unlike LLCs, which cannot issue stock, S corporations can issue shares of stock, though limited to 100 shareholders and one class of stock. This allows for equity-based compensation, such as stock ownership or profit-sharing plans, which can attract and retain top talent. It also enables founders to offer financial incentives to key employees without immediately affecting cash flow. Though S Corp are more restricted than C Corp in terms of shareholder eligibility, the ability to leverage stock for strategic partnerships or exit strategies can yield long-term financial advantages. 7. Avoiding the 3.8% net investment income tax, NIIT. High-earning LLC members may be subject to the net investment income tax, NIIT, of 3.8% on their passive income. However, S-corporation owners who actively work in their businesses and classify their remaining profits as distributions often avoid this tax. Since only passive income or investment income is subject to the NIIT, and S-corp distributions are not considered passive when the shareholder is materially involved, this structure can help reduce or eliminate the extra 3.8% tax burden for qualifying owners, particularly useful for high-income entrepreneurs. 8. Better succession and exit strategy planning. When it comes to planning for the sale, succession, or transfer of the business, S-corporations offer clearer exit strategies and often more favorable tax treatment than LLCs. For instance, selling shares of an S-corporation may allow for capital gains treatment, which typically results in lower tax rates than selling assets held in an LLC. Additionally, S-corp may be more attractive to potential buyers due to their more formal structure and clear shareholder records. These features can provide long-term financial benefits during transitions and business sales. 9. State-level tax flexibility. Some states allow S-corporations to elect out-of-state level pass-through taxes, offering further savings. For example, in states with pass-through entity, private, taxes, S-corp can pay state taxes at the entity level, allowing the owners to deduct state taxes on their federal returns, which helps circumvent the $10,000 SALT cap, state and local tax deduction limit. While LLCs in those same states may have access to similar elections, S-corp often enjoy easier administration and better compliance support from tax professionals familiar with corporate structures. 10. Cleaner books and financial management. S-corporations are required to maintain accurate financial records, prepare balance sheets, and follow formal accounting rules, resulting in better financial discipline. While this formality may seem burdensome to some small business owners, it leads to cleaner books, easier tax preparation, and greater audit protection. These standards often encourage better budgeting, improved cash flow management, and transparency in financial reporting. LLCs, by contrast, have fewer compliance requirements, which can sometimes result in poor recordkeeping and missed deductions that impact the bottom line. While LLCs offer simplicity, flexibility, and liability protection, S-corporations bring a range of strategic financial benefits that can be game-changing for many entrepreneurs. From tax savings through salary and distribution splits to enhanced retirement options, greater health insurance deductions, and access to investor capital, the S-corp structure is designed to reward business owners who prioritize long-term planning and tax efficiency. However, it's not a one-size-fits-all solution. S-corp come with more formalities and stricter IRS compliance, so business owners must weigh the administrative responsibilities against the potential financial rewards. For those ready to scale, protect wealth, and reduce unnecessary taxes, forming an S-corporation could be the smartest financial move they make.